Welcome back, Renee, to the Growth Concept Podcast. Thank you so much for coming on this episode to share your investing insights with us today. Thank you, Renee.
Thanks, Kieran, for having me.
This is a two-part series. We've done the first one going into sorting your finances out and establishing that solid foundation. And now we're going to go more into the detail of the investing side of things as well. So, Renee, first question to start off. What has one book that has helped you understand finance and money a little bit more clearer?
A couple of books I use is I love The Financial Feminist. The author Tori, she explains quite well that we're not born with a money mind, and you pick up so many traits from our background and our family experience. It takes education and practice and time to really master money management. She kind of debunks some of the money myths and exposes many areas to, stay out of debt and stuff like that. Another one that everyone loves is The Barefoot Investor. I'm sure you've heard of it. It's in most people's homes. The thing I love is any book that draws attention to budget and cash flow. Scott, the author, has 9 simple steps to financial freedom. He breaks down simply how to budget and really stick to it. He uses bucketed bank accounts to run your life smoothly and efficiently. He touches on some other important areas like controlling debt, looking at buying your first home, increasing your super, and more importantly, like protecting your family wealth. So a couple of books that I guess has helped many clients along the journey.
So moving into section 1 of this interview, going into what the investing landscape is, could you walk us through some different investments out there?
Sure. There's many investments out there, but the main topics and investments are direct equities or stocks. That is a direct ownership in a company.
Okay, yep.
For example, I use Commonwealth Bank. If you own one stock, you own one shareholding in the Commonwealth Bank of Australia.
So is that equity and a stock the same thing?
It is.
Gotcha.
People use different names for them, right? Managed fund. Managed fund is a bucket or a pool of direct stocks. So that managed fund will have its own investment objective. So they might, for example, invest in the top 200 Australian stocks. That's their investment objective. We also have the new guy on the block, which is the ETFs, exchange traded funds. They've been around for a while, but they seem to be very popular at the moment. They're very similar to managed funds, so they've got that pooled style, and they're listed on the exchange, so easy to buy and sell and trade.
What's the difference between that managed fund and exchange traded fund ETFs?
A couple of technical points, but it mainly comes down to liquidity and the trading of them.
What's liquidity?
The buying and selling of them, how quickly you can buy and sell.
Gotcha,
And there are some little underlying things that are different, but we won't get into that today. Other things are real estate. You know that you can get domestic and residential property, commercial as well. Crypto, we all know about crypto, new guy on the block as well. A digital currency with an online system that's bought and sold online. Pricing fluctuates quite heavily depending on the market. We have term deposits and annuities. They're really common and popular for a lot of portfolios. These are typically cash-based products that are provided by banking institutions, and they usually have that fixed time frame and a fixed rate.
Right, okay, that's awesome. So for someone starting out with investing being new, how do they know where to begin with looking for their investment category?
I believe this comes down to personal goals. Everyone is different and they seek different outcomes from their investments. For example, some feel like saving for a house is vital for them, where I have others that want to live abroad and travel for a long period of time. So investing in, say, the share market appeals more to them. I feel most important, the investment tool is building a foundation and having an investment strategy. Our foundation is securing your personal banking and that budget, like I mentioned. Once that foundation is secure, you can then go on to start investing. Direct investing, I'm personally a fan of what I call organic growth for young investors. What this is using, say, extra income or capital or funds that you already have.
Yep.
And start investing that. You can use things like what I said, the managed fund or the ETF, exchange traded fund. What this does in that pooled portfolio, it provides exposure for a small amount of capital. So again, you can have a small investment, could be $1,000, $5,000.
And be exposed to
like a whole
market.
sector. So instead of traditionally buying one stock, like I mentioned, in CBA, you can actually buy one stock in a managed fund or ETF and have exposure to that whole area.
Definitely adds that diversity as well.
Yeah, and before jumping into any kind of trading, we always want to strongly suggest researching and gaining that personal advice, as they can help direct you and help you understand your goals and what you want out of your portfolio.
Yeah, and they really tailor a strategy around your needs as well.
Yeah.
So that leads us on to, what is a strategy?
An investment strategy is a set of principles designed to help you as the investor achieve and set out your goals. So like I mentioned, it's not one size fits all. It does depend on people's age, their personal situation, their affordability, their goals at hand. A financial strategy should include things like personal risk tolerance and market volatility. That means when the market goes up and down and rides that wave of the share market, your investment objective and the type of strategy. So that means, are you a growth, value, passive or active investor? You can blend those between different sectors. Another thing to put in an investment strategy is, how are you going to look at directing your earnings? So the earnings or the interest that you make, or extra capital that you put in. How are you going to utilize that? Are you going to use a dollar cost average strategy, or are you going to direct reinvest those?
I just want to touch on, you said there's passive investors, active investors. What is a passive investor?
So passive investor uses passive investments. So they can be like our index-based investing. Index-based is when it's a calculated model.
Yep.
So for example, with the Australian index, that could be investing in the top 200 or 300 stocks in the Australian exchange.
And active?
An active is where a fund manager between that index will try, with their analytical data, try and pick and choose the best quality and try and strive to outperform the index.
Okay, yeah, so they're trying to win that race.
Basically.
Gotcha.
Yeah.
How important is an investment strategy for someone starting out?
It's crucial. Before you start investing, you need to understand what your personal investment strategy is, because like I said, it is different for everyone. And knowing your goals and what type of investments you should aim towards and how to reduce the risk in the portfolio. Setting targets and outlining certain points for yourself will see you not jumping around impulsively trading when times get tough. And your investments aren't scattered from one end of the market to the other. You should have a plan and a purpose for your portfolio.
Should someone have an exit plan as well in their strategy?
Can do, again, depending on the goals that the client has. It might be a long term, so it might be riding out that market, or it might be an exit strategy if it's a shorter to medium term, say like a house deposit or something like that.
Yep. So what other things should I consider in my investment strategy? Because you spoke about having your goals in mind. Yes, that's very important. And knowing if you're long-term, short-term. Is there a couple of other things I should be aware of as well?
In an investment strategy, I feel diversification is key. Diversification means that you're spreading your money and your assets over different classes and sectors and industries. What diversification does is it lowers your portfolio risk And it can boost your returns over the long term because different asset classes perform at different times. Although it does not guarantee against losses, it can just help reduce some big corrections, which means some downturns in the market, and diversification in different areas. So not investing, all your eggs in one basket.
Yeah, yep.
What it will do is it will make sure you spread it out, and the returns over the long term will try and provide you with an average above the industry. I always have clients ask, why don't we simply invest in that stock or that managed fund that outperformed, overachieved last year? Even with the most research possible, many different factors contribute to the price movement of these individual shares or managed funds and every other different investment. We can't a lot of those are out of our control. So even though it achieved so much last year, it doesn't mean that it's going to be the best winner this year.
Yeah, so definitely having that diversification helps.
Yeah.
So for new investors that may be worried about their risk, how can they manage their risk in a way with today's market? How can they manage their risk in today's market?
In the market, there are different risks and returns for different types of investments. Low risk generally means lower expected returns or close to cash rates, while higher returns usually are associated with higher risk. For clients with extra income, I love a good dollar cost average strategy because that is designed and tries to mitigate market risk. Dollar cost averaging is an investment approach where you invest the same amount of money over on a regular basis, usually each pay cycle or monthly or quarterly, whatever suits your budget and your affordability. Dollar cost averaging is also convenient. It can kind of be like a set and forget. You can set it on each pay cycle, and it will just give you additional exposure to the investment over time, like drip feeding it, like watering your plant. The benefit of this strategy is it reduces investing a large chunk of capital or money in a single time, and it might be the wrong time. The market might go down, or it might be an expensive time to buy. Dollar cost averaging, if you do that on a smaller basis, interval investing, and it will average out the purchase price.
I guess it kind of removes that, should I buy?
Yes.
It's like, I have to buy now. That emotional...
Controls the impulse, right?
Yeah, that impulse buying is removed, which I find so crucial with investing. Let's move on to your lessons and experience with investing. What is one lesson you've learnt the hard way with investing?
An investment has a great track record. It doesn't mean it will remain excellent all the time.
Yep.
I have learnt that the hard way. Direct stocks are impacted by so many things. That can be from current policy and government changes. It can be supply and demand changes and issues, or in-house politics in the company. This can change the business profits or the attractiveness of the company to the market. Therefore, you'll see that fluctuation in the price. So I've learnt the hard way as well by assuming that because the stock had a fantastic run in the last year, I'm going to back that horse.
Yeah.
And it hasn't always paid off.
That's
That's it.
You see that a lot in cryptocurrencies with one tweet or one person saying a specific thing, and that crypto go and skyrocket or crash.
Yes.
I guess same principle applies with equities or stocks. What would you recommend with avoiding your lesson for listeners?
I think avoiding backing the favourite with everything you've got. So again, do not put all your eggs in one basket.
Have that diversification.
Correct. Go back to your investment strategy. Make sure you diversify in line with what you feel in the market. So make sure you don't put everything in one area Because like I said, different sectors perform at different times. So don't put it all in one area, because if that market does well, I'm sure we'll high five. But if it's the opposite and it's struggling at that point of time, maybe whether it's in that point of year or against supply and demand, it can all of a sudden have a sharp downturn, and that would see your whole portfolio or holdings reduce. So I've learned the hard way.
That's right.
Try to avoid that and look at your diversification.
Yep. For someone new to the market, what is the best way with learning everything? Because for someone starting out, it can be so overwhelming. What are a couple of resources that they can explore?
I suggest jumping online and check out some of the awesome beginner guides, or pick up some financial books that we talked about earlier. The main thing is these books are not going to suit everyone. Every chapter is not going to be applicable for you.
Yep.
But if you can take away one or two meaningful points, that will stay with you for life. That will help educate you in certain areas and try to improve your cash flow or your knowledge in a certain area. Do your own research. Once you have the basis down, then you can direct yourself into investing in areas that interest you. You asked about a couple of resources.
Yep.
I have two that I give young investors. First one is jump online to the ASX website. They outline different investment options, how to buy and sell online. They have some online courses, and they have a cool share trading game twice a year, so you can have a little bit of a go in a simulated environment, which is pretty cool.
And you don't need to pay for this?
No, it's an online function that they provide, so it's an educator tool. So you learn more about the market. So jump onto their website. There is a section that is dedicated to education and providing information to the general public, which is great.
Yeah, I've done a couple of those courses and I found them so beneficial with just understanding the foundation, because everything kind of links back in the end.
Yes, it does. Another one is Morningstar. It is a research provider that provides lots of investment articles. It provides direct stock reviews, what's been happening with those companies, and it has a full education department as well. Has some news topics on different sectors and touches on some of the things we've talked about today, like risk and return, diversification, dollar cost average. All of those things have different articles on there that you can, in your own time, go back on and have a look.
Yeah, definitely. I got one last question for you, Renee. What is one thing you wish you knew about investing with the knowledge you have now, if you were going to talk to your younger self before you got started?
I wish I knew the true positive impact of salary sacrificing in super at a young age. When you're young, you don't focus on super, as retirement's so far away. But over time, superannuation can be one of our biggest assets, and it's a great tax-effective income for our future. It's something you're going to need for your family in the future. Salary sacrifice provides great tax deductions along the way.
So what's salary sacrifice?
Good question. It is where you put in some of your income from your employer. You put in your earned income to your superannuation before tax.
Before tax, so it's not taxed yet.
Correct. So what will happen is your employer will allocate what you've nominated. So say it's $100 a pay cycle. They will allocate and direct that $100 to your superannuation for you pre-tax. It does get taxed at the superannuation fund. But what it can do is it can provide you a tax deduction up the front end, but what it is doing for you long term is building that super nest egg for you to retire on later on. And the compounding interest over that long period of time through our working career in our life is priceless.
Definitely. But when saying that, with salary sacrificing, I guess it relates back to what your goals are, but that's money that's not going to go in my bank account. I can't access that until retirement age, whatever that may be for super. I can't access that money till then. Wouldn't I be better off having that money now and investing that into the stock market, for example?
Good question. Yes, you can't possibly touch those funds now, and it does come down to what that person and their goals are. It comes down to the extra money that you set aside from your everyday budget and setting aside your goals. This is a small contribution to your super. You don't have to do that, it is voluntary. But like you said, what have I learnt over those years is I've learnt compounding interest, whether that's your direct investment or whether it is using your superannuation to build that wealth. And super just provides you with that tax deduction. So it's just a strategy to think about, but it is something, again, you need that personal advice around and make sure it's something that you can afford and it's something that is appropriate for your position.
And you have that strong foundation set before you start.
That's it.
Awesome. Well, thank you so much, Renee, for coming on this episode with talking about your wisdom and expertise with investing. I'm sure so many people have benefited from this. Thank you so much, Renee.